Welcome to Connected by Community, a podcast sponsored by Ballentine Capital Advisors. My name is Anne Thompson. We're here to connect the community with different organizations, small businesses, personal endeavors, and not-for-profits. I'm joined today by Bryan Ballentine, the founder of Ballentine Capital Advisors. Welcome, Bryan.
Thanks for being here. I'm glad to be here.
We're going to have an interesting topic today. We're going to talk about taxes and other miscellaneous items that people really need to know entering into 2024.
So don't stop the podcast. It's about taxes, but don't stop. We're here to save you. Right?
That's right. This is good information.
And notice we don't have, no offense to CPAs, we love them, but this is just kind of talk about kind of weird strategies, right? Or like odd things.
I'm all for it. I need to learn some odd things so that I know what to do going into next year. So going into next year, or we're in next year, 2024, and tax season is coming up in a few months. When should people do their taxes? Let's start that.
Yeah, let's just start with some general. So in general, I would say historically, I find most people do their taxes too early. Now, a lot of times maybe it's because they're anticipating a tax refund. The problem is, unless you just have a simple W-2 situation, it's probably too early for you. 1099s are rushed out to accommodate requirements by the IRS, and then oftentimes nowadays there are amendments to those. And what we're finding is when those amendments are sent out, you've already done your taxes, then you have to file an amendment to your taxes. So because of all that, we encourage people with simple tax returns to wait at least till March. And if you have a complicated return, probably at least until April 1st, if not closer to the end. That doesn't mean you can't be prepared to push the button, meaning give your CPA, give your accountant, or if you self-prepare, get it ready to push the button. But all we're saying is maybe not push the final button till that end, because you may get everything loaded and you may get a corrective 1099. And understand, a corrective 1099 is just a 1099 that was sent to you early February, that by the end of February or mid-March, they say, the numbers we sent you, they weren't right because we had to rush it out the door. Here are the corrected numbers, and it might only be off $100. But if you file it, the IRS is going to have the corrected numbers, and you have to file a corrected return. So, and if you have K-1s, you might just want to file an extension and start there. I think a lot of people probably need to consider that. Unfortunately, that's just the where we find ourselves.
So what is a K-1? I mean, a lot of people listening might not know what a K-1 is.
Yeah, K-1's typically a business entity when you have a partnership of some sort. If you have a K-1, you probably know you have a K-1. If you don't have a K-1, you probably don't need to know it unless you got into a partnership.
Yeah.
But it's a special type tax return for partnerships. They typically are delayed anywhere from the very end to right at April, because they file their own business extension and they don't get them in. Sometimes they don't come even till the summer, forcing you to do your taxes later on the extension. So very, very often when people have K-1s, they're filing extensions. I've and as we've gone along, I've kind of just through the years, I've told people, don't be afraid of the extension should that happen. Understand an extension does not give you the right to extend your obligation to pay. So unfortunately, if you owe $10,000, you still owe $10,000. You're expected to know that ahead of time. So you need to get with your CPA or accountant and do a good faith estimate. You might even slightly overpay if you don't want to pay a penalty. If you're not worried about the penalty, pay as close as you think you owe. But you still need to send in your estimated payment on the tax deadline. That does not negate that at all. But if you have a K-1 or a complicated situation, even just a complicated situation, CPAs and accountants get busy. This whole thing of pushing everything through by April 15th, I think is ridiculous. And every year I say this more and more, and this is my year of just saying, just extend. If you have a complicated situation, you don't have it figured out, do not push it through. Do not make errors yourself. Have your CPA make errors. Breathe. Take time. Do it at the end of April. Do it at the end of May. Do it at the end of June. You are not forced to do it. You're not forced. You are supposed to pay in the amount you owe, but you are not required to finalize your return. You can file an extension. You have extra time if you do that. Breathe. Do it right. Get all the documents. Send in the amount you're supposed to do. And I think more people ought to consider that if it makes sense. I'm not a CPA. Consult with your CPA. But I think a lot of people ought to have that consultation with their CPA. If you're going to file an extension, there's no reason to wait till the last day. You're filing an extension.
Right.
So what I'm getting at is if you have a complicated, do it April 1st, do it March 15th. You're just saying, hey, here's about what I'm going to owe. Send it in. Push the button March 31st so you don't have stress.
Right.
Take the month of April or May, figure it out. Don't have the stress. I think what I've seen over the last 4 or 5 years is the entire world go crazy because stuff has gotten more and more complicated. Every year it's more complicated. Stuff's later and later and later. And there's this mad rush of April 15th. I see more individuals making more mistakes, more custodians sending stuff with mistakes, and frankly, more CPAs making mistakes. And I just think maybe it's time for a lot more people to pause and just get it right and not be in a stressful situation. Even if it was the week after April 15th, I think it might just be easier.
Most things end at the end of the year, December 31st, but there are some items like IRAs and Roths that you can contribute to. You have until tax day to contribute to. Tell me a little bit about that and how IRAs might be changing in 2024.
Yeah, so if you qualify for an IRA or Roth IRA, for 23, you can fund that through tax filing date in 24. Okay. So you can back fund. It's like a coupon, I call it, right? So based on 23's qualification. So if you do your taxes, figure out you can do it, you can go ahead and fund it. Then in 24, you could go ahead and fund 24s as well at the same time, or you have until April or tax filing date of the next year to fund in 25 to fund 24s. Now, the amount that you can put in 2024, I had broke down on my cheat sheet, is going to be $8,000 if you're over 50, $7,000 if you're under 50 for an IRA or Roth IRA.
Okay.
For a 401k, if you're underneath 50, it's going to be $23,000. If you're over 50, it's going to be $30,500. So
that's for 2024, but 401ks you only have until December 31st, correct?
Because it has to be payroll deduction.
Yeah. Okay.
Yeah. And there's some other type plans based on the scope of this, this podcast. We probably don't want to go into every plan. If you have a SEP or a Simple or some of these other type plans, certainly call us. But those cover the vast majority. There's 457s and et cetera, the vast majority of folks. But you do have the ability to back fund those.
Right.
And in the state of South Carolina, you actually can back fund a 529 and get a state deduction as well.
Oh, wow. Yeah. All right. So I work with a lot of older people doing planning and financial management. So one of the weird questions that I've heard from them is, what is the age I no longer have to pay taxes?
Yeah, so the simple answer to that's never. The IRS has no love for you the older you get.
Yeah.
The other part of that is, do you ever not have to file a return? The answer is no. That has to do with your income, nothing to do with your age. So it's possible you don't have to file an income or tax return if you made no money, but it all has to do with the amount of income. So there is no forgiveness based on age. There are some deductions based on age, but there is no forgiveness of taxation based on age as we get older.
So there's a lot of myths around retirement. One of them being it's cheaper for people to retire in a state income tax-free state. I mean, what are your thoughts on that?
No, that's possible. I think you have to be careful because I'll use South Carolina as an example. I think we actually don't get enough credit in South Carolina. Not that I'm encouraging more folks. I shouldn't say this. This is going to be on. So I always joke and say we're full, taxes are high, crime's high, weather's terrible. You don't want to come here. We're on every list of best states and places to live nowadays, and we're pretty popular. And so our infrastructure is starting to struggle to keep up. So I joke and say that, right, because Woodruff Road's terrible. For real, it is, guys, if you're moving here. Do not move on Woodruff Road. But so I say that to say South Carolina does not get enough positive credit because, Social Security is not taxed, military and pensions aren't taxed. You get a special federal deduction on the state level. It's pretty economical from a state. Most of my retirees in South Carolina pay very limited tax on the state side, right?
Okay.
And our property taxes are manageable. But you move to a state like Texas, which has no state income tax, but the property taxes are sky high, right? Or you move to a state like Florida, and your insurance, if you can get insurance on your house, big question, right? Might be fourfold, right?
Right.
Let's just call that a tax. I'm talking a cost of living, right?
Right.
So when you start weighing that, is it really substantially different? Now, it's probably different than New Jersey, right? I love New Jersey. I got friends from New Jersey. It's not to beat them up. It's just we probably still have a cheaper cost of living there or California, right? So
Right.
we still are winning those races. When you take a California, Illinois, New Jersey, New York, those type really expensive, high tax places.
Right.
But don't just assume because it's tax-free, it's necessarily cheaper. They're making it up somewhere. Sales tax, property tax, levies and fees. I believe it's the state of Georgia. Their sales tax when they buy a car is unlimited, I believe. Don't quote me on that.
Wow.
I know it's a lot higher in South Carolina. South Carolina's maxed at $500. So they can get you in fees and ancillary things. And so, what does it really cost to live there is what you have to look at.
Right. That's a good point. And I mention that to people, but they don't always think that.
Well, and I think the other thing, do you want to live there?
Yeah. Yeah.
Now, I mean, no disrespect. I'm looking at our list of, we just kind of wrote these down. South Dakota. I mean, I'm sure it's a fabulous state to visit, but it's probably pretty cold right now. And I'm just sitting here thinking, South Dakota is lovely, right? For any of our listeners out there in South Dakota, South Carolina probably has a few advantages over South Dakota, weather-wise, lifestyle-wise, cultural-wise. I mean, a lot of reasons, right? So, let's just say it costs you $2,000 more a year. Is that worth being able to go to Charleston or Myrtle Beach or Hilton Head? Or that's a personal. You know what?
Right.
Or are you stuck in the middle of the country at negative 50 wind chill factors?
Yeah.
I don't know. I mean, that's a personal choice.
Yeah, definitely. So a lot of people think when they go into retirement, they're going to drop into a lower tax bracket. My dad has RMDs, required minimum distributions, from his retirement accounts, and that has seemed to throw him into a higher tax bracket in retirement than he was in when he was working. So what are your thoughts there?
Yeah, so for people that have been real savers and didn't spend a lot, it really can. Yeah. So let's say you're a real saver, you're an engineer and lived a reasonable, frugal lifestyle, and you socked away $2 million. And up until RMD status, you lived on $60,000 a year, $5,000 a month. So I can do the math in my head. And you never took any money out of that IRA. Now it's worth $2 million. And so that I can do the math in my head, let's call your RMD 4%. It's not 4%. It's a little bit less than that the day you start probably, but just for argument's sake, it's about $80,000, right?
Right.
And so between your Social Security, let's say that didn't change, now you got to take $80,000 on top of that. Now you're paying a lot. So it could throw you in a new tax bracket. It could affect your Medicare potentially through something called IRMA.
Yeah.
It could affect your Social Security tax. So it can be a big deal. And then it goes up and up and up and up and up. And so doing Roth conversions before you hit RMD, maybe just taking distributions as you go along, managing that process.
Right.
Not just to plug Ballentine Capital Advisors, but having a wealth manager that helps you with that wealth way before then it's important.
Right.
It's just complicated. I was actually in the hallway the other day with one of our team members talking about it, and just how complicated all the stuff we do is. And I actually, even though it obviously gives us a full employment, I wish Congress would make it easier. It just doesn't need to be this complicated.
Yeah.
But I don't know that the public actually realizes how complicated all the moving parts of the taxations, the investments, the rules, the regulations really are.
Yeah.
And even really smart people, I think sometimes maybe they make wise choices, but they just don't know what they don't know.
Right.
And I feel sorry for the public because they're not able to know. No different than I couldn't answer your question about the specific tax day.
Yeah.
Because I'm not a CPA. I don't pretend to be, right?
Right.
That's why we have CPAs that are at our disposal, and maybe we should have had them on this podcast. But because it is so complicated, right? And so it's critical, but they can catch you in these type things, and it's important to have somebody on your team and have multiple players on your team.
Oh, I have a CPA because I don't want to.
Right.
There's way too many rules and regulations, and I, if I don't need to know all that stuff, I got my own business. I have to have knowledge for knowing all the tax rules and regulations and the changes that come up. I mean, you and I, in what we do with wealth management, we have kind of like a cheat sheet we refer to all the time on what would be a tax bracket if somebody passed away and their married filing jointly, and then they end up the next year having to file single. I mean, there's tax bracket changes that are going to happen with those individuals, and I have something to refer to. I don't have to memorize those tax brackets. So that's always good to know. What are some big things that might be changing going into 2024? Anything that stands out in your mind that you've heard about tax-wise that might be changing?
Well, I think one of the things we got to be aware of is the upcoming, it's not in 24, but it's upcoming after that is the upcoming, we have the election in 24 and what happens with the Trump era tax cuts, right, when they expire.
Yeah.
It's been called the mother of all fiscal cliffs. No matter how you feel about the tax, the taxes cuts, if they're set to expire and Congress doesn't do anything, it would be the largest tax increase, I believe. Don't quote me on this, ask your CPA, in history, right? So it's a big one, right? And will certainly have a financial effect should that happen. So positioning yourself to be prepared to take action should that happen, that might mean in 24 you pay a little more tax than if the cliff happens and what you do. I think the other thing that might mean is how do we utilize assets in 24? You and I were talking before. I think one of the most underutilized things people do is something called a donor advised fund and the gifting of highly appreciated assets. Oftentimes people walk into my office and they're giving to their church or charity or they're giving to their kids and they're writing checks and they're sitting on a bunch of appreciated assets.
Right.
And I just, it's either they haven't told me or I've recommended they do something else and they haven't listened to me, or they're a new client and I hadn't had the opportunity. But I think it's a mistake for most people. If they have non-qualified assets and they're appreciated, whether it's individual stocks, mutual funds, or ETFs, you can gift those to a charity directly or through something called a donor advised fund, which we could have a whole podcast about. A great tool for a long-term charitable planning vehicle. Or you can gift them to a kid. And in in all cases on the charity, if you're already given to a charity, it's going to be a win. If you were given cash, and giving to a kid can be a win. I can't say that's always a win, but if you're giving your kid cash and your kid's in a lower tax bracket than you, certainly if they're outside of what's called the kiddie tax and they're over 26, it's a win. And they're in a lower tax bracket than you. But there's a lot of things there we'd need to talk about. But I think that whole area is misunderstood by people, and it's not complicated, but it takes some technical maneuvering with someone like ourselves. That's the problem.
Yeah.
It's not necessarily hard, but it does take work, and it takes someone like us who knows what they're doing to do it the right way and to know which button to push, how to push them, and where to push them. And even your CPA might even probably won't tell you about them, but even if they did, probably won't do them for you. So I think that's definitely underutilized. But thinking of the Trump era tax cuts coming like a cliff, it really is. And I won't say warning, but just be aware. I think next year is a big planning year for taxes.
Right.
And I think people need to be aware of that and what they're doing. It won't happen till the following after that, but let's just have that in the back of our mind as we head into the year. And other than that, I think it's most of the things are standard. Nowadays you can't take a ton of deductions, so it's not anything crazy you can do. But I think those are a couple of things we can think about.
So it's all about strategy. It's all about thinking ahead and strategizing to your future and utilizing those donor advised funds and using kind of the growth that we've seen in the market over the last 10 years and people sitting on appreciated assets is something that has to be kind of like long-term planning that we like to do with clients. Now, that is a donor advised fund. That is with brokerage accounts and instead of giving cash to charities. Let's hit a little bit on what we call qualified charitable deductions from IRAs. Can you go into some detail on that?
Yeah, so great point. So if we have someone who's 70 and a half, the IRS allows you to take directly from your IRA and give to a charity. So if you are giving to your church or other 501(c)(3)s, such as American Red Cross or something like that, you can give it straight to them and not have to pay income tax on that. So it's tax-free. So it's on the front of the 1040. So there's no need to take a deduction whatsoever. It also can double dip if you're RMD status and you're 73 and count as your RMD and is non-taxable. So it's a win-win. So great tool, great vehicle. Certainly, I'm not, we don't want to fast forward our life, but if you're not quite there yet, there is an advantage once you get to be that age. That their government has allowed for that, so that's one
Right.
out. That if your RMD is 80,000 and you're giving 10,000 to the church, you can certainly allow 10,000 of that to go directly there, and you don't have to write that out of cash flow. So great vehicle. Almost all accountants and CPAs will go along with that because it's almost I won't say there's ever a universal recommendation. I'm not saying that now, but it's almost an absolute thing that it's good for anyone that's already giving.
Right.
And so I highly encourage that. And churches and charities have become accustomed to that over the last couple of years. It's now been around for a few years. And so the key there is just doing it the right way, filling out the right forms. A couple quirks there is making sure you understand the 1099 when it's issued is not going to note that as self-reporting. We can talk about
Right.
that if clients have questions. But anyway, it's a great tool, great vehicle for those 70 and a half.
Yeah. Is there a max that you can give to charity in any 1 year once you're 70 and a half from your IRA? Is it capped?
You're testing my distribution knowledge. I don't believe so.
No, it is.
I think it's $100,000.
Yep, that's it.
Yeah. So yeah.
I don't know many people that are actually giving $100,000 out of their IRA, but
I had to stop and think about it for a
Yeah.
second. Yep. So yeah, but the other part of that cap is, don't quote me on this. You can only give, I think it's 50% of your. Well, that's on the deduction side. I want to wait. We're going to hold off on that on the podcast. I'm getting into CPA stuff I shouldn't. There are limitations on the deduction side, so we want to be careful on how much. If you're getting into giving more than 40 or 50% of your income, or actually more than 30%, call me. We need to have a discussion because there are limits in general on how much you can give. Most people aren't going north of the 30% number.
Right.
So there are some percentage limit qualifications as well.
Right.
In addition to dollar limits. So been doing this 25 years, I don't think I've ran into that.
Okay.
So I'll say for all intents and purposes, there are no limits. If you're going to give a large amount, let's talk about it privately because for all intents and purposes, we don't run into it. The only time, I have run into someone giving a lot of money. It has been a large stock sale. Someone had $1 million and they were given $100,000. That's 10%, right? Mm-hmm. I've never had. I'm going to take a QCD and give $200,000. So that's just not been. I'm not opposed to that. I'm all for charity.
Yeah.
I'm just saying that's the reason we haven't run into it when you look at a percentage.
Right.
So yes, the IRS has some limits. Call us. They also change all the time. So I want to be careful stamping this whenever this runs. This podcast runs. That doesn't mean that's the limit when this runs, or whenever someone watches it 6 months later.
Right.
Yep.
Good deal. Well, any other thoughts that you would like to inform people about in reference to our topic on taxes today?
Yeah, so read Wealth on Purpose, a book we released in 2020, late 2023, Chapter 6. Talks a lot about tax and tax planning. Sincerely talks about it integrated into the planning. I would encourage people to do that.
Yeah. Now, who wrote that book, Bryan?
I happen to write that, so with over 3,500 edits, so yeah.
Well, congratulations on getting the book published, and we look forward to seeing it on shelves, and it's at Amazon. So definitely Chapter 6 is all about taxes and your suggestions, right?
Yeah, thank you much.
All right. Well, thank you for joining us today at Ballentine Capital Advisors. We appreciate all that you do out there for our community, and we thank you for joining us. Connected by Community is brought to you by Ballentine Capital Advisors, a local Greenville-based wealth advisory firm. Thank you very much. Have a great day.